This happened in September 2008 during the GFC and could repeat in September of 2024 and trigger a market crash. Here are 5 highlights. 1. US bank reserves became scarce when the Fed implemented quantitative easing. 2. This liquidity crunch intensified the financial crisis. Repo market froze. 3. What has changed since then, to reduce the risk of a repeat of the 2008 liquidity crisis? 4. What usually happens in September, and what could go wrong in September 2024? 5. Reverse repo is at very low levels, while SPX is at all-time highs. Is there any correlation between them that could trigger a market crash? Now let's dive in. During the 2008 financial crisis, the repo market faced severe liquidity stress as financial institutions struggled to obtain short-term funding. As the crisis unfolded, the value of the collateral, primarily mortgage-backed securities and other complex financial instruments, plummeted. This led to a sharp increase in haircuts, the discount applied to the collateral, causing lenders to demand more collateral for the same amount of cash. US bank reserves became scarce when the Fed implemented quantitative easing, as the lack of confidence grew in the counterparties, and declining asset values led to a run on the repo market, where borrowers were unable to roll over their repos or obtain new funding. This liquidity crunch intensified the financial crisis, as the interbank lending market froze and banks became increasingly risk-averse and reluctant to lend to one another due to fears of counterparty default, impacting the repo market. So, what usually happens in September, and what happened in September of 2008? Usually, September is a regular period of withdrawal from banks and money market funds to meet quarterly tax payments. Therefore, this period usually causes a scarcity of reserves, which was so pronounced in the fall of 2008, that led to the collapse of Lehman Brothers in September. The Federal Reserve and other central banks tried to intervene by injecting liquidity and expanding their roles in the repo market to stabilize the financial system. To address this, the Federal Reserve initiated a series of emergency measures. Number 1, liquidity facilities. The Fed introduced several facilities, such as the Term Auction Facility and Primary Dealer Credit Facility, to provide liquidity to banks and primary dealers. Number 2, quantitative easing. Beginning in late 2008, the Fed started its first round of QE, which involved purchasing large quantities of longer-term securities, including US Treasuries and mortgage-backed securities. These purchases injected substantial reserves into the banking system, alleviating the scarcity of reserves and lowering borrowing costs across the economy. By increasing the supply of reserves through these measures, the Fed aimed to stabilize the financial system, restore normal functioning to credit markets, and support economic recovery. So, what has changed since then, to reduce the risk of a repeat of the 2008 liquidity crisis? Learning from the 2008 and 2019 disruptions, the Fed established a new Standing Repo Facility, SRF, to proactively provide liquidity whenever needed. This facility has a capacity of $500 billion, which is expected to be sufficient to handle liquidity demands during future periods of stress. Also, banks frequently hold substantial reserves that are now incentivized by the Fed, which pays interest rates on reserve balances. Even non-banks, such as money market funds, can also park money at the Fed's overnight reverse repo facility. Additionally, the Fed introduced another repo facility called the Foreign and International Monetary Authorities, FEMA, repo facility, allowing foreign central banks to access dollar liquidity. These mechanisms act as a floor system, allowing the Fed to control short-term interest rates. Looking ahead, a new ruling by the U.S. Securities and Exchange Commission from December 2023 mandates a shift to central clearing of repos by June 30, 2026. What could still go wrong in September of 2024? The Treasury market seems more fragile now than it was before the global financial crisis. Algorithms account for 60% to 80% of trading depth at any given time, but they tend to shut down during periods of high volatility, such as market scares. This can exacerbate fragility during risk-off events, especially with dealers constrained by post-GFC capital rules. There is a circular relationship between the Fed and the markets. The Fed cannot precisely determine in advance when reserves will shift from being ample to scarce. Instead, it relies on market signals and pressures to gauge when a tipping point might be near. September is a regular period of withdrawal from banks and money market funds to meet quarterly tax payments, and this period usually causes a scarcity of reserves, which brings more stress to the market and will put the new Fed's liquidity instruments to the test. Reverse repo is at very low levels, while SPX is at all-time highs. Is there any correlation between them that could trigger a market crash? Another area of high risk is that the overnight reverse repo facility is now getting down to low levels, raising questions about whether another breakdown in financial market liquidity and stress in short-term funding markets could occur. I have discovered a clear inverse correlation between the reverse repo and the S&P 500, SPX. I posted this chart on my TradingView account, link in the description if you want to check it out there. In January 2022, the chart shows that reverse repo started to increase, while, at the same time, SPX started to drop, showing an almost perfect inverse correlation. On May 2023, the chart shows SPX at the start of a bull market, while the reverse repo starts a downtrend. What I have noticed is that when they are running beside each other, at some point they start to go in the opposite direction, and when they are far apart from each other, at some point, search for a cross with each other, while one goes down the other goes up. Today, reverse repo is at very low levels, while SPX is at all-time highs, so the big question is a big move incoming to repeat the inverse correlation pattern? Another question is, if the pattern follows, how much will the stock market crash when the reverse repo starts to spike up? For now, I do not see a breakout of the downtrend for reverso repo, but we need to keep very close attention when that happens, to review all our investment strategies. Since I had never seen this analysis between the reverse repo and the S&P 500, I had to publish the idea as soon as possible to warn as many people as I could about what could happen at any time. If you have seen any similar analysis, let me know in the comments below where you saw it and what do you think it will happen. The bottom line, the institutional features are in place and have changed the market structure to reduce the risk of a repeat of 2008 and 2019. But everything has a limit at some point, and something is unbreakable until it breaks. That lesson, I believe, we all have learned from the Titanic, which is, never doubt a natural force's power. I believe that even on an abstract reality, such as the money and markets, the principle follows, and when this natural force decides to act, no one can stop it, otherwise they could have prevented what happened in 2008 and 2019. Technical analysis is not 100% perfect, as any other financial instrument that tries to predict the market, but the warning signals I have captured from the inverse correlation of the US reverse repo market and the US stock market are very strong. Therefore, if we start to see a strong uptrend in the US reverse repo market, now we know what could happen: a stock market crash. In my experience, this is the best time to review all investment strategies, cutting risks as much as possible. Let's hope for the best while preparing for the worst. Good luck and good profit, my friends. By Edward Cash Trader. Disclaimer in the description below. If you would like to support us, feel free to smash the like button and share with your friends all the valuable information.